Let's talk about paying off loans early, whether it's a mortgage or a car payment or some other type of loan. One of the most important factors in whether to pay a loan off early is what is the interest rate? That's a very important place to start. So what is the interest rate? My question mark looks weird, often signified as I, a cursive of sort of cursive I. What is the interest rate? We've talked before about how saving on interest is similar to earning that amount with an investment. So if you have a loan with 20% interest, you will likely want to tackle that early. And basically everyone in the financial space will tell you that. If you have a loan out for 3%, a mortgage at 3%, there would be other things to consider. So this would be, a 20% versus 3%. The considerations are different, but it is not obvious that you would want to pay off a 3% mortgage early. If you have multiple forms of debt, paying them off with the avalanche method or the snowball method or things we've discussed in prior videos, paying the highest interest rate one first or paying the lowest amount loan first to get it off your books. That is sort of a different part of this. But another consideration is whether the debt is for an appreciating or depreciating asset. That's a really important thing. If it's a debt that helps you generate income, that's another consideration. If you took out a loan to help your small business, for example, and you're using the principal to scale your business, probably doesn't make sense to rush to pay it back the second you have the funds, given that the whole point of the loan in the first place was you can make a higher return by growing your business than what the interest rate is that you're paying. Maybe there's another investment you want to make. For example, when interest rates were low on mortgages at 2 point something percent, and you might expect over the long term to make 7% in the market, you might say, well, I'm going to keep the mortgage at 2.8% and then take the difference in cash that I am not putting into my home and put it in the stock market. I'm not suggesting you do that. I'm not saying it's a good strategy, but it would be a consideration. Paying 2.8 on my home, which appreciates, and then putting money to work for me in the market rather than just paying off that mortgage and only saving 2.8%. With credit card debt, it can't be argued that the balance is doing you any good. With credit card debt, you would be much more inclined to pay it off early, even setting aside what the interest rate is. Car payments are another form of what we might call bad debt. I've talked to you about how you probably want to avoid financing a car if you can. It is a depreciating asset, in particular now 84-month. I think I've seen 96-month loans on a depreciating asset like a car. If it's an emergency and you have no other choice, and I would question whether you have no other choice, you might have no choice but to get into such a situation. But car loans are not typically considered good debt. You may also owe more on the car than it's worth, especially when you add up the interest over time. So that'd be another reason to look at paying off the car loan early. But mortgages are really the biggest question. This is the really big one. And the issue with the mortgage payoff is it will depend on how much you have outstanding. Is it 20 grand? Is it 200 grand? Is it 2 million? Okay. What is the interest rate? That's another factor. What's the opportunity cost of paying it off early in terms of what you could otherwise do with that money? And there's also the psychological effect. Some people get a financial sort of sense of financial freedom from paying off a mortgage, knowing the bank can't repossess it anymore. Now, you might not pay your property taxes. There's a lien. Okay, but we're talking about specifically related to the mortgage. If you lose your job or can no longer work, you don't have to worry about a mortgage payment. You also don't have to worry about the payment in general, and you will save on interest by paying off a mortgage early. But as we talked about early, if the interest rate is 3% and you could make 7% over the long term in the market, what about that arbitrage opportunity? That's a question to consider. You also will be giving up liquidity, because if you put the money into the mortgage, in order to get that money out if you need it, you either need to sell the home or get a loan against the equity. It's not as easy as having the money in some other forms. And then also a consideration is the tax deductibility. Mortgage loan interest is tax deductible up to a certain amount that changed with the 2017 tax cuts, limiting at $10,000. When you now pay off your mortgage early, you lose that tax benefit. You may be losing part of that tax benefit anyway, depending on your tax situation, something you have to discuss with your accountant. Now, you may be one of these people who are saying, even if it's not the optimal thing financially, I still want to pay it off earlier because of the psychological burden. That's totally legitimate. That still is a real thing. But it also can be considered in dollar terms. What is that psychological value in dollar terms? How much is not having the burden worth to you? And does it surpass the amount of money you could make when you look at the opportunity cost minus the interest payments? In a sense, it's still a math question. It's just how much is that psychological burden worth to you? So many things to consider. This is why we call it personal finance. It really depends on your particular situation.